IFRS 5 Non-Current Assets Held for Sale and Discontinued Operations addresses the accounting treatment and presentation requirements when a parent entity disposes of its investment in a subsidiary. A complete disposal occurs when the parent loses control over the subsidiary through sale, liquidation, or other transactions transferring ownership rights. The disposal significantly affects both the parent's individual financial statements and the group consolidated financial statements because the subsidiary ceases to be part of the reporting group. IFRS accounting standards require recognition of gains or losses arising from disposal and recognition of subsidiary assets, liabilities, goodwill, and non-controlling interests. Proper accounting ensures that financial statements accurately reflect the economic consequences of losing control and provide transparent information regarding discontinued group operations and ownership changes. In the parent's individual financial statements, the gain or loss on disposal is generally calculated as the difference between disposal proceeds and the carrying amount of the investment in the subsidiary. Disposal proceeds may consist of cash, shares, deferred consideration, or other forms of compensation received. The carrying amount represents the value of the investment recorded in the parent's own accounts before disposal. Any resulting gain or loss is recognized in profit or loss during the reporting period. This treatment reflects the economic outcome of the transaction from the parent entity's perspective as an individual investor. Accurate calculation is important because disposal transactions can significantly influence profitability, retained earnings, and investment performance reported within separate financial statements. In consolidated financial statements, accounting for complete disposal is more complex because the subsidiary's assets, liabilities, goodwill, and non-controlling interests have previously been included within group accounts. Upon disposal, the group derecognizes all subsidiary assets and liabilities from the consolidated statement of financial position. Any associated goodwill arising on acquisition is also removed. The carrying amount of non-controlling interests relating to the subsidiary is derecognized as well. The gain or loss on disposal is calculated by comparing disposal proceeds plus any retained investment measured at fair value against the carrying amount of net assets disposed of. This ensures that consolidated financial statements reflect the termination of control and removal of the subsidiary from the economic entity. When a parent completely disposes of a subsidiary, any amounts previously recognized in other comprehensive income relating to the subsidiary may also require reclassification. Examples include foreign currency translation reserves, revaluation surpluses, and cash flow hedge reserves associated with the disposed subsidiary. Depending on applicable IFRS requirements, these reserves may be reclassified into profit or loss or transferred directly within equity upon disposal. This treatment ensures that cumulative gains and losses previously deferred in equity are appropriately recognized once the related subsidiary leaves the group structure. Accurate treatment of reserves is important because disposal transactions often involve significant cumulative adjustments affecting profitability, equity balances, and overall financial statement presentation within consolidated reporting environments. Complete disposal of a subsidiary may also result in presentation as a discontinued operation under IFRS 5 if the subsidiary represents a separate major line of business or geographical area of operations. In such cases, results of the subsidiary are presented separately within the statement of profit or loss to improve comparability and help users distinguish continuing operations from discontinued activities. Separate disclosure includes post-tax profit or loss from discontinued operations and gains or losses arising on disposal. This presentation improves transparency regarding future group performance because disposed operations will no longer contribute to future cash flows, profitability, or operational activities. Investors and analysts rely heavily on this distinction when evaluating sustainable future earnings and business strategy changes. Overall, IFRS 5 provides a structured framework for accounting for complete disposal of shares and subsidiaries within both individual and consolidated financial statements. By requiring derecognition of subsidiary assets, liabilities, goodwill, and non-controlling interests together with recognition of disposal gains or losses, the standard ensures faithful representation of changes in group ownership and control. The treatment of reserves and discontinued operations further enhances transparency and comparability within financial reporting. Disposal transactions can significantly affect profitability, financial position, strategic direction, and future group operations, making accurate accounting essential. For DIP-IFR candidates, understanding subsidiary disposals is important because business restructuring, acquisitions, and divestments are common within multinational corporate environments governed by IFRS accounting standards.